In 1983, a single legislative session in South Dakota eliminated the rule against perpetuities, the 900-year-old legal principle that prevented wealth from being locked in a trust forever. Within 2 decades, an estimated $600 billion followed that decision. The families who move first are not planning to pay estate taxes, ever. The generation-skipping transfer tax was created in 1986 with a specific purpose: to prevent dynastic wealth from leapfrogging estate taxes by passing directly from grandparent to grandchild. Congress set the exemption, set the rate at 1.55%, and considered the problem structurally solved. The tax code would work as a pressure valve. No single family could accumulate compounding, untaxed wealth across infinite generations. That was the design. On paper, it held. What Congress did not fully account for was the competition between states to attract trust business. South Dakota moved first. Governor Bill Janklow signed the repeal of the rule against perpetuities in 1983, allowing trusts chartered in South Dakota to run without a termination date. The immediate goal was modest: attract bank and trust company business to a rural state with limited economic levers. What the state created, without fully announcing it, was the legal architecture for hereditary wealth accumulation on a timeline that now extends, in some instruments, to the year 2365. Nevada followed in 1995. Delaware, which had long dominated American corporate law, amended its trust statutes to permit perpetual trusts in 1995 as well. By 2020, 28 states had eliminated or dramatically extended their rules against perpetuities. Each revision was framed as modernization, as keeping pace with sophisticated estate planning. The language in the legislative records is careful and procedural. Words like dynasty and permanent wealth transfer do not appear. The mechanics, however, are precise. A family places assets, a business interest, a real estate portfolio, a securities account, into a trust chartered in South Dakota. A directed trust structure separates the investment advisor from the trustee. The trustee, domiciled in South Dakota, administers the trust under South Dakota law. The generation-skipping transfer tax exemption, currently $13.61 million per individual, is applied at the moment of funding. After that, the trust grows, distributes to descendants, and passes across generations with no additional transfer tax applied. Not deferred, not reduced, not applied at a lower rate, not applied at all. The first crack in the public narrative around estate planning is a number that does not appear in most coverage of this system. The South Dakota Department of Revenue reported that trust assets held under South Dakota law crossed $600 billion in 2021. That figure comes from the state's own data. South Dakota has a population of 909,000 people. It has no income tax, no capital gains tax, and no trust income tax on accumulated undistributed income. The ratio of trust assets to state population is not an accident of geography. It is the direct and documented result of a policy architecture built across 4 decades, one amendment at a time, that transformed a Midwestern state into the onshore equivalent of a private banking jurisdiction. The wealth is American. The tax obligation, structured correctly, has been made optional. In 1983, South Dakota Governor Bill Janklow signed Senate Bill 95 into law. It abolished the rule against perpetuities, the 900-year-old legal doctrine that prevented wealth from being locked inside trusts indefinitely. The official justification was economic development. The actual result was that South Dakota became the first American jurisdiction where a trust could legally hold assets forever, passing them from generation to generation without triggering the generation-skipping transfer tax, which Congress had designed in 1986 specifically to prevent exactly this kind of dynastic accumulation. Nevada followed in 1995. Delaware followed in 1995 as well. By 2003, 17 states had abolished or severely curtailed the rule. The race was not accidental. Trust attorneys and family office advisors had drafted model legislation and circulated it to state legislators directly. The mechanism was not discovered, it was engineered. The generation-skipping transfer tax was written to impose a 40% levy every time inherited wealth skipped a generation, from grandparent to grandchild, bypassing the estate tax that would have applied to the middle generation. Dynasty trusts circumvent this entirely by never completing the transfer. The assets do not pass. They sit inside a perpetual legal entity. Beneficiaries receive distributions from the trust. They never own the principal. Because ownership never transfers, the taxable event never occurs. The IRS documented this structure in a 2000 Treasury Department report that described dynasty trusts as capable of accumulating wealth across what it estimated could be a 360-year compounding horizon before any tax liability materialized. That report was submitted to Congress. No legislation followed. The money moved quickly. By 2010, South Dakota trust companies held an estimated $226 billion in assets under administration. By 2020, that number had crossed $367 billion according to South Dakota Division of Banking annual reports. A single institution, South Dakota Trust Company, founded in 1997, processed trust structures for clients whose aggregate wealth placed them consistently in the top 0.01% of American earners. The family offices coordinating these transfers were not small operations. They employed tax attorneys, compliance officers, and former IRS officials whose institutional knowledge of audit triggers made the structures more airtight with each iteration. One documented example: the Walton family's trust architecture, reported in detail by ProPublica in June 2021 using leaked IRS data, showed effective federal tax rates on fortune transfers that approach zero across multiple generational transfers, achieved in part through trust structures resident in low-regulation states. The human cost does not appear in any trust document. It appears in the gap. The Tax Policy Center estimated in 2017 that full enforcement of the generation-skipping transfer tax would recover approximately $25 billion annually, revenue that instead compounds inside sealed trust vehicles. That figure represents the annual federal funding shortfall for Head Start by a factor of 5. It exceeds the entire annual budget of the Environmental Protection Agency. The communities absorbing those funding gaps, rural school districts, municipal pension funds running actuarial deficits, infrastructure maintenance budgets in post-industrial counties, have no legal standing inside a trust instrument. They are not parties, they are externalities. The auditors who reviewed the trust structures signed off on instruments that were compliant. Compliance and consequence occupied different ledgers. The point of no return is not a single date. It is a compounding threshold crossed silently. When the Treasury Department's 2000 report was filed and ignored, when South Dakota's trust assets crossed $100 billion without triggering federal review, when the 2017 Tax Cuts and Jobs Act doubled the estate tax exemption to $11.18 million per individual, rather than closing dynasty trust loopholes, each decision narrowed the legislative window further. As of 2024, an estimated $600 billion sits inside perpetual trust structures, with no sunset clause, no mandatory dissolution date, and no mechanism for public recovery. The wealth is not hidden, it is sealed, legally, permanently, and with the full architecture of American contract law as its vault. No federal investigation was ever opened. No prosecution was ever brought. No settlement was ever reached. The architects of South Dakota's 1983 trust law revision, the lawyers, the legislators, the family office consultants who rewrote the rules, faced no consequences. What they built was not a loophole. It was legislation, and legislation is not a crime. The Senate Finance Committee examined dynasty trusts in 2007 and produced a report. The report produced nothing else. The IRS has issued guidance, adjusted valuation rules at the margins, and collected commentary. It has not dismantled the structure. Congress has introduced bills to cap the rule against perpetuities exemption at 90 years. None have passed. The money kept moving. By the time the public conversation caught up to what South Dakota had done, Nevada and Delaware had already followed, and 17 states had joined the architecture. The system is still operating today, not in shadow, not in secrecy, in plain daylight, in trust documents filed with state courts, in family office annual reviews, in the quiet transfer of assets that the generation-skipping transfer tax was specifically designed to interrupt. The tax exists. The exemption from it, stretched across centuries, exists alongside it. Both are law. What that means is that a trust established today in Sioux Falls, South Dakota, carrying assets placed just below the taxable threshold, faces no scheduled termination, no planned tax event, and no legal mechanism requiring it to ever end. The wealth does not circulate, it compounds. The heir who accesses it in 2200 will do so under terms written now, in a jurisdiction that rewrote the meaning of forever 40 years ago, and no one who built that system has ever been asked to answer for it. The specific irony is this: the generation-skipping transfer tax was passed in 1986 precisely because Congress had watched wealthy families use trusts to skip taxation across multiple generations, and decided it had to stop. It took South Dakota 3 years before the fix to find the workaround. The fix is still on the books, so is the workaround. Both are federal and state law simultaneously, right now. Tell us in the comments what you think. Is this a legal system working exactly as designed, or a design that was never meant to be found? If this is the kind of documented structural story that most channels will never touch, subscribe, because every week we expose another system they hoped you would never understand.